Got it. Got it.
Ready.
All right, my friends, this is a treat for me. I got a guy I've been reading for a long time, at least 10 years. I'm sure it's been more than that, but I can't remember. This is Edward McQuarrie. Am I saying your last name right, Edward?
Close enough for government work, Josh.
That's all that matters. As long as it's good enough for government work. But Edward is a professor, emeritus. I can never pronounce that word, emeritus.
Oh, that's I forget sometimes. We say emeritus, and
Emeritus. There you go.
if your audience is not part of academe, let me explain briefly.
Please.
Professor emeritus means they don't have to pay me anymore, but I can still claim affiliation.
You're going to kick out of this. One time I got out of college, I was trying to interview for something, and I can't remember what it was. And a guy says, "Send me your vitae." I was like, "What the hell is that?" I don't know what that is. He goes, "Your resume." I said, "Well, I just called a resume."
Because in academia, it is the curriculum vitae.
It's your CV. I was like, okay, but right on. But Edward, you've been writing, and you got a great blog, and we'll link all that stuff. I enjoy it very much, and obviously, I think there's some stuff that I would say I don't agree with you. It's fine. You know what I'm saying? It's crazy. People can have a disagreement and still go drink a beer. It's nuts. Who would have thought? I don't know. It's crazy, but it's just a lot of fun. The thing that I was so excited to get you on board here is the article that, or the not just article, it's a long paper, a very detailed paper, taken, I don't want to say taken to task, that's kind of the wrong term, but like bring into, what's the word I'm looking for? I guess challenging some on Jeremy Siegel's book, Stocks in the Long Run. And, Siegel's Wharton, well, and I like Siegel, big guy. I mean, he's been, pushing stuff out for a long, long time. And I got no issues with him at all. I got two of those books that I've read. It's been very helpful to me in my own career. But I just loved how I don't want to say challenge. You know what I'm saying? It just called into question some of the data that came up with, and I think that's I love it, and that's why I'm so excited to have you come on board today. So thanks, Edward, and if you don't mind, just introduce yourself, and we'll just go from there.
Right. All right, I'm Professor Edward McQuarrie, Professor Emeritus at Santa Clara University. I retired back in 2016, and I needed something to do. Okay. And what that something proved to be was a deep dive into the history of the US stock and bond markets. And what eventually resulted was the paper that Josh mentioned, which we're going to touch, sort of work through today on this broadcast. And I'll have more details as we go on. But just remember, how did I come to do this? I was retired. I had time. Okay. All right. So now we do the Zoom thing. I try to share my
screen. Share my screen.
Here.
I got to make you the host again. Hold on a second. And we're going to change hosts. So you are now the host, Edward, and you are good to go.
Good.
By the way, while you're doing that, there we go. Sweet. Nice. Oh, yeah. All right.
Okay.
Cool.
Okay. Or did I think I clicked on the wrong one. Let me kind of go to the different window. Okay, I think. Sorry about that, everyone. There we go.
All right.
Okay, good.
Absolutely.
So the title of the paper, and basically everyone, what I'm going to do is I'm going to present, and once in a while I'm going to ask Josh a question, and then after that he's going to say, whoa, slow down there, I got a question for you, and this will be as much dialogue as lecture. All right. So the title of the paper is Stocks for the Long Run, ? And the answer, sometimes yes, sometimes no. Now, let's see. Doesn't want to, there we go. All right, so this is the 6th edition of Jeremy's book. It started 30 years ago. This one came out in 2022. And Jeremy Siegel, way back in 1992, took the stock and bond record back to 1802. And what he found in that work, and I'll show you a chart in a minute, has set expectations for long-term asset returns ever since. I am, see if you like this word, Josh, I am contesting the
Yes.
Siegel narrative here. Okay. So let's spell it out as a thesis. Siegel basically asserts that stocks will beat bonds over any lengthy interval, and that annualized stock returns will converge on 6 to 7% real over any multi-decade holding period. Or if you're more used to nominal terms, if you spend your days as I do in the stocks, bonds, bills, and inflation yearbook, 10% nominal if inflation runs 3% plus. Siegel's thesis is a scientific hypothesis. It's intended to apply always and everywhere. 19th century, same as the 20th century. International, same as USA. And so here's what everybody knows from Siegel. This is an edited version of in a panel I did with Jeremy. We came to call Jeremy's iconic chart.
Yeah.
And I got rid of the gold and the inflation lines. I don't have any information on bills, by the way. And in fact, what he calls bills is actually commercial paper. It's got no theoretical role. So my work is about stocks and bonds. Okay. And as you can see in Jeremy's telling, basically stocks go up, 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 and bonds dilly-dally and don't get very far. In fact, here's my first question for you, Josh. Here, when you look at this chart, if you were a reverse Chat GPT, okay, you can give Chat GPT words and it comes up with pictures.
Right.
Now, I gave you the picture here.
Right.
Tell me in words what Siegel's chart shows.
Well, it looks like it's saying that a buck invested in bonds is worth over 200 years is worth 1,100, 1,400 bucks, and a buck invested in stocks is worth $1 million.
Okay, so stocks beat bonds. Okay,
that's significant,
and that's what most people see when they see this chart.
Yes,
I'm going to help the audience see Siegel's chart a little bit differently. If you look down on the lower left corner, this is a 200-year chart. What do you see inside the red box? What I see is stocks and bonds performing about the same for the first 60 years of Siegel's record. But you have never read that in any journalistic account. You have never read that Siegel asserts that stocks do not beat bonds in the first 60 years of his sample, but it's right there in his chart.
Right on.
Now, even more difficult to see without a visual aid. Okay. Right. I drew those two arrows beginning in 1982. They're sort of visual lines of best fit for the stock line and the bond line. And I don't know about you, Josh, but those two arrows look very parallel to me. Okay. Absolutely. So even using Siegel's own data, it's been apparent that there have been multi-decade periods when stocks did not beat bonds. But to see it in Siegel's chart, you have to overcome what behavioral finance calls misleading heuristics. Investors, unfortunately, tend to ignore the lower left corner in long-term charts, assume that lines that end up diverged must have been spreading apart all along, have an inability without a graphical assist to reset performance lines midstream. Okay, so that was Siegel's data. Now I'm going to start showing you my data.
Right.
Okay, and just quickly, not everybody's going to read the paper, so I figure I better get this stuff in early. I went back and assembled stock and bond returns from 1792. Okay, and when I say stocks, I mean a capitalization weighted, dividends included measure of total return. Dirty little secret of Siegel's research is that he did not observe dividends until 1871.
Really?
He kind of went, I think about here. Okay. We'll come back to that. Now, in some ways, even more radical. Siegel never observed any bond prices before 1926. What financial economists and economic historians do is they put together yield series. And with a couple of simple formulas, if you know the yield at the beginning of the year and the yield at the end of the year, you can extract the price appreciation or price depreciation on the underlying bond.
Mm.
So all of Siegel's 19th century bond returns are yield extracted. Now, I had the benefit of groundbreaking research by Richard Silla at New York University. Silla got a grant in the late 90s, had deployed a team of researchers. This is before digitization. He sent them to the dusty archives, and he got bond prices and stock prices from 1792 to 1860 or so. So I observe bond prices. I observe federal, state, and corporate bond prices. And so my returns are on observed prices and coupons. Now, for best comparability to Siegel, to best contest what he found, I have no new data after 1925. That's when the Ibbotson Stocks, Bonds, Bills, and Inflation series begins. And so I just linked to that data, which is the exact same data as used by Siegel. Okay, so everything on the right side of my charts is identical to Siegel, but of course, with a different starting point because I have very different data before 1926. All right. So let's see. On my screen, Josh, I can't see the upper right side of figure one. Can you see it on yours?
We see the graph, yes, sir. We see the red and blue lines. You don't see that?
Oh, okay. So no, yeah, no, it's just happens to be the way my screen's set up. Our picture's in the way, but your audience can see the blue and orange squiggles there on the upper right.
Yes, absolutely. Yes,
Okay,
sir.
good. So for this chart,
Yeah.
visual aid, I simply reset the stock and bond lines
Yeah.
equal at the beginning of 1982, and I scaled them so that I can fill in the rest of the chart in the next few slides. And what was, what you needed those two red arrows to see before, I think is perfectly apparent now. Okay. Since 1981, stocks and bonds in the United States have performed about the same. There ain't no spread. There ain't no fork, if you will. But let's go back another 40 years. Whoa. That is the 20 years following World War II, up to a date that many of your viewers will recognize, 1966 or so, the roughly 15-year high point in the Dow Jones average. That's where the spread comes from. Stocks wipe the floor with bonds. Now, the red square is just 20 years. Bonds didn't finish tanking until 1981, the whole 40 years. But now we have, I think, a fresh perspective on the spread that everybody sees in Siegel's charts.
Yep.
And now here's the entire new record that I compiled, again, appended to the existing record after 1925. On all these charts, you could always recognize 1929. Okay, that's what it looks like in 200-year context. And so now, what do we see on my chart? What I like to call the corrected historical record. What we see is that for the first 150 years, stocks and bonds performed about the same.
Yep.
It was a horse race. And then something changed after World War II, and stocks soared ahead of bonds. And then after 1981, the status quo ante was restored, and stocks and bonds poke around together in a horse race. Okay. Now, going to drill down a little deeper here. Actually, no, let me stop, Josh. Questions?
Yeah. So when you were doing this research, did that shock you, Edward? Where you're like, wait a second, this is, I mean, you didn't know that going in when you were reading Siller stuff, I assume. So were you just like, whoa, this is what caused the discrepancy of the stocks dominating bonds, that 20-year time frame.
Yeah. The first 2 years were very much a journey of discovery. Okay.
Yeah.
And when I started to see it, and by the way, it was only when I went back way before the Civil War. Okay. We'll see in a minute that that's the crucial difference in my data versus Siegel's data. Okay. It's for stocks, it's before the Civil War. And for bonds, as we'll see, it's after the Civil War. So only when I started going back, into the 1790s, the 1820s, et cetera, only then did I start to get excited.
Yeah.
Whoa, this is not what the Siegel history shows. I have made a discovery.
Yeah,
And
exactly.
and let me tell you, it was a long 5 years in the archives, Josh, and that helped to keep me going. Okay. All right, let's take a look at the next slide here. So this is Siegel's slide again. Now we can see more clearly that before 1862, before the Civil War, I haven't actually changed that much relative to the Siegel record. Okay. And, you can see pretty clearly that after the Civil War, there was a very long multi-decade rally in bond prices. It's just that in Siegel, it starts from a much lower point. Okay. And again, everything from about here to the right is just the same data, Siegel and I. Okay. This next slide will help. So basically, the elevator pitch, somebody asks you after you finish this YouTube video, what was this all about? The answer is simple. McQuarrie found lower stock returns in the first 60 years and higher bond returns in the second 60 years. And that was enough to pinch together lines that had been separate in Siegel. Okay, so I haven't changed a lot, but I've changed enough to give a very different picture of the first century and a half of the stock and bond returns here in the United States. Let me kind of just drill down a little bit here. Okay. You see this little dip in the blue line. That's not really there in Siegel. And actually, I can probably go to the next slide for that. Okay. Basically, Siegel sources left out the bad stuff. Okay. His early 19th century stock returns come from two Harvard guys named Smith and Cole. And let me tell you how Smith and Cole put together their 7 stock series. Okay. I got dozens. Siegel was using 7 stocks. And it's kind of a funny story.
No, wait, just 7 to represent the entire stock market? That's what his base was?
That's right. That's right. And now, Smith and Cole had the same dozens of stocks as I found in Richard Silla's data set, but they threw away all but 7. And do you know why? These guys are cycle theorists. They were after the Holy Grail. What predicts the business cycle? Can we find it in stock returns? And they had a pre-modern understanding of statistics. So the way they picked those 7 was they charted each stock. They had all the price data from the old newspapers. They charted each stock on a transparency. They stacked those transparencies on a light table, and then they pulled out all the ones that were discrepant, like the one that went,
Right.
Okay. And what happened after the Panic of 1837 was that the second bank of the United States, equal in capitalization to the Magnificent 7 today, something like 30% of the total U.S. stock market capitalization.
It was in that one bank.
In that one bank, the one left out by Siegel sources.
Wait. So 30% of the entire U.S. market capitalization was in one stock, and they didn't use that, or Siegel didn't use that in his stocks long run thing.
Well, see, Smith and Cole didn't have share count. Okay, they couldn't do capitalization weighting. So not only did they throw the second bank out, even if
Right.
they put it in, they wouldn't have capitalization weighted it.
I got you. Right. That's, man, that's
Okay.
nuts, man. And that's the basis of, okay, keep going. That's,
So the second bank of the United States fails spectacularly. It goes from $120 a share to $1.50 per share. Okay. Imagine the Magnificent Seven next month falling 99%.
that's
Okay.
crazy.
The Panic of 1837 is rivaled only by the Great Depression of the 1930s. It's literally the second worst downturn in United States history. And Siegel sources left out the bad stuff. Okay. Thus giving a falsely inflated view of the performance of the US stock market over the centuries. Okay.
I didn't, yeah, that's, all right. Yeah.
Okay.
That's fascinating.
Good. Okay. Now, um, it turns out that although I have lower stock returns than Siegel, I also have higher bond returns.
Yeah.
Okay. Now, it'll be a rare member of your audience who can tell me who Frederick Macaulay is. If I say the concept of bond duration, people will recognize duration. Okay, very important measure for bonds.
Yeah.
So Siegel got his yield series from Sidney Homer, who wrote a book, The History of Interest Rates. And Homer got his yield series from Macaulay. And Macaulay, and he thought, poor Sidney Homer thought, yeah, because this is in Schiller too. It's not just Siegel. This bond series is in Schiller's spreadsheet as well. Homer thought Macaulay was reporting an average of, a dozen or two New England municipal bonds, Boston,
Yeah.
Massachusetts, rocked rib conservative,
Yeah.
very high quality bonds. Okay. But it turned out Macaulay, he was way more, how shall I say, esoteric than Homer understood. Macaulay wasn't taking an average. He was going, well, if this is how much the bonds that I see yielded, this is how much a bond of superlative credit quality would have yielded if one had existed. So in the early decades, the bonds used by Siegel, the yield numbers he has were 100 basis point lower than the actual average.
What?
Yeah, yeah, yeah. Again, I told your viewers, I retired.
Right.
I had time. Okay. I had time to go back to
Yeah.
Joseph G. Martin, A Century of Finance, published 1898. Okay. Macaulay's source. So I went back to the source and I said, okay, here's Macaulay. Here's the source.
Yeah.
What? Okay. So when I observe actual bond prices, I start with the bond with, say, an extra 100 basis points of yield, which all
Yeah.
things equal, is going to translate into an extra 100 basis points
Right.
of return. And relative to Schiller, who assumes a 10-year maturity, the actual maturity on many of these bonds was 20 years or more. And you know what happens to long bonds during a great rally, okay?
Yeah.
And in the last half of the 19th century, bond yields fell, the observed ones, not the silly ones in Macaulay, bond yields fell from 6.33% to 3.33%. An enormous rally,
Yeah.
totally underplayed in Siegel's sources.
So
Okay.
bond yields fell by 50%. The respective prices went up. Yeah,
That's right.
that's okay. That's a big
Okay.
deal. That's a big deal.
Yeah. So that's why keep in mind now, Jeremy Siegel, now a professor emeritus as well, was a Wharton chaired professor, a good friend of Robert Schiller's, the Nobel Prize winner, a student of Paul Samuelson, a PhD from MIT on the Chicago faculty. And to challenge Siegel,
Right.
I had to get my ducks in line. Okay, and that's why I'm laying out the details here.
Right. You
Yeah,
can't do that.
yeah.
You can't do that half-ass. That's for sure.
You'll lose your head.
Right.
All right. So actually, let me remember. Okay, good. All right. So now this chart will look a little bit more clear, and I'm going to leave the U.S. history behind in a moment. Josh, any final questions about what you see here?
Just I didn't know about the thing with the yields, and certainly I read your thing about the Bank of the United States. That was actually kind of shocking. I'm
Yeah.
still, man. We keep going, and we're
So,
just
there's a colleague of James Grant, Grant's Interest Rate Observer,
hmm,
said exactly the same thing to me as you did.
yeah,
How could they leave out the largest single
right.
stock? What's with
Like I said,
that?
that's a magnificent seven. That if they just fell
Yeah,
99%,
yeah, yeah.
I
Yeah,
mean,
you'd have a pretty good simulacrum of what happened after 1837. Okay, so that's why the bond line,
hmm,
the stock line falls. See, the other thing I have here in my stock series is, I've got the railroad bust of the 1850s.
yeah,
Okay. There was a bubble, and then, basically a lot of these stocks tanked. Then there was the panic of 1857. Many of the railroads in the North were rescued by the Civil War. Okay. It was one of those origins of the belief, not necessarily factual, but widely held among some investors that, well, war is good for stocks.
yeah,
It certainly was for railroad stocks in the North in the Civil War. But basically, so my new data has the stock line low and the
yeah,
bond line starting from a higher place. And now we have the much bigger
yeah,
stock rally because I'm basically using Siegel's stock data from about here on.
yeah,
It's the Robert Schiller stock series from Cows. Okay. But because of the difference in starting points and the stronger bond returns, it's neck and neck through World War One.
yeah,
Of course, stocks soar in the 1920s, plunge in the 1930s, go down again in 1937, 1938, and they're still like this
yeah,
after
absolutely.
150 years. All right, enough of that. Let me get to the very probable. We'll skip that one for now. Okay, now, actually, okay. Now, generally at this point, your reader who, kind of is receptive to history, but a practical person says to me something like this. Very interesting, Professor McQuarrie, but 200 years ago? How is that relevant to
Yeah,
my investing horizon here in the 21st century? Okay. And, when I wrote the paper, I anticipated that objection.
yeah,
Okay. That too many practical people are just going to dismiss it. It's too old, you know, way back when,
yeah,
kind of thing. Come on, move along here. Okay. So I'm going to come back to this caution later and develop it in more detail. Okay. I want your viewers to be very clear. This presentation is not an argument against stock investing. It's really reinforcing what you already know. Stock returns are volatile. You knew that was true over 1 year. You might have guessed it was true over 10 years. I'm here to tell you it's true over 20 and 30 years too.
100%. Yep.
Okay. So again, how many investors care
Right.
what happened 200 years ago? And so I thought, I better bring in some converging evidence here. I better reinforce my point. Now, uh, not all your viewers knew that US stock and bond returns go back to 1792. And I'm guessing even fewer know that British stock returns go back to 1700.
Mm,
Okay. And of course, the international record, which was a little slower to come together than the US record, it's been greatly expanded over the past 3 decades. You have Dimson, Marsh, and Staunton wrote a book in 2002, Triumph of the Optimist. Data from 1900 on a dozen different markets outside the United States. A fellow named Brian Taylor at Global Financial Data has been taking international data even farther back. A team headed by Jorder et al., website here, they've taken a bunch of data back to 1871. And if you like to play with this kind of stuff, go download it, okay? Turns out, certainly the post-1900 data is not terribly supportive of part B of Siegel's thesis.
Yeah, interesting.
Over 120 years, world ex-USA returns equaled 4.3%, not 6.6%. Oh, hey, sorry for the unauthorized interruption here, everybody. Hopefully there'll be appearances, but not barking. Moving right along. So let me quote from their 2020 Credit Suisse yearbook. Of course, it's a UBS yearbook now, but they wrote, a dollar invested in U.S. equities in 1900 produced $1,937 after 120 years. An equivalent investment outside the U.S. got you $179. So can I say that Siegel's thesis suffered a 90% shortfall outside the United States in the current century? This is not 200-year-old data. Now, you and your viewers have probably heard the old saw. If you can hold on to your stocks for 20 years, you are home free.
Yep.
Sorry. What I did, and this data comes courtesy of Brian Taylor at GFD, is I went cherry picking, okay? I went and looked for the worst 20-year period and 30-year period and 50-year period in Brian's corpus of data, some of which goes back to 1700 or so. So, very important. When you introduce international data in contesting Siegel, you will receive the following pushback. You will hear, yeah, Germany lost a war there, you know, got bombed into the Stone Age. Japan too. And Belgium, oh, the poor Belgian investor invaded and occupied twice within 30 years. Okay. Now, Professor McQuarrie, I don't think war-torn nations are relevant to my investing here in the 2020s.
Right.
If the US is bombed into the Stone Age, I'll have other things to worry about than my portfolio. So it's very important for me to remind everyone that I first took out the bad stuff. There is no Germany 1945 here. There is no Belgium 1914 to 18 or 1941 to 1945. I got rid of all the war-torn nations. I got rid of the periods where these nations were occupied, invaded. Spain had a civil war. Portugal had a civil war. Those were removed first. So these are the worst outcomes in intact nations outside the United States. And as you can see, I found a dozen instances of 20-year periods. Yeah. And again, these are all real returns. These are after inflation returns. Okay. If you got your phone there, everybody, just take out your calculator and let's see. Compound 0.95 for 20 years and tell me how much wealth you have left.
Look at Japan. I just can't get over Japan, man. It's crazy. You know,
okay.
Japan.
But yeah. You know, this is the 20 years after 1989. Okay. Right. Hey, but this is the 20 years before 1932 in Sweden. I mean, Sweden, tall, blonde. I mean, what's not to like? Okay, kind of thing. Norway. And this is not Italy in the 1930s. Right. This is not Italy and Mussolini. This is Italy from 1959 to 1979, after the recovery from the war. Just didn't work out too well for stock investors then. Okay. Now, in peacetime, if you can hold for 50 years,
Right.
I only found one negative real return. If you go into the war-torn countries, of course, you can find more. All right. So this is the first part of Siegel's thesis, the A part, if you will. Hey, hold on for the long term. You're going to get 6 to 7% real from stocks. Well, yeah, a lot of the time you will, or even better, but not all the time.
Right. Not even close. Yeah.
Okay. Now, what I did here, this is the equity premium. This is the annualized stock performance minus the annualized bond performance.
Gotcha.
And the war years are back in here because, war should be bad for bonds, same as stocks. So this is how often I found an equity deficit. And there's plenty of these in the US in the 19th century. That's what I'm trying to reinforce here with this international data. Okay. Well, in 19 out of 19 cases, I could locate a 20-year equity deficit where you did better in bonds than stocks. Well, 18 out of 19 over 30 years, and 12 over 9 out of 19 over 50 years. Okay, so let me try a preliminary summary here, and then I'm going to anticipate some, I won't call them objections, I'll call them misconceptions. So bear with me here for the summary.
Absolutely.
What the new record shows is that sometimes stocks beat bonds, sometimes bonds beat stocks, much of the time over intervals of arbitrary length. It's a horse race. Investors in favorably situated nations have indeed received stock returns of 6% real, compounded, sometimes.
Yeah.
Over less favorable intervals, even if many decades in length, we have seen stock returns as low as 2%, 3%, or 4% in the lucky countries. Okay. And just for a benchmark here, if you earn 6% every year, you increase your wealth by a factor of 8x over 35 years. You only earn 4%, you quadruple your wealth. You only get 2%, you only double your wealth. Okay. My point then is that even absent war, stocks can stay down for longer than your planning horizon extends.
Absolutely.
Okay. Now, gonna kind of now that I've got the new history out there, we're gonna spend a little time in terms of what does it mean, but also what does it not mean. Okay. In my personal opinion, investors should still be optimists.
Yeah.
I've got a young adult child.
Mhm.
He's working in Silicon Valley, making the big bucks,
Right.
maxing her 401k, backdoor Roth, mega backdoor Roth, maybe 75,000 a year across the 3 different retirement accounts. And I told her to put it 100% in stocks. Okay. Because, most of it's a Roth account.
Okay.
She won't have to take distributions ever. It'll go to her heirs 80 years from now. Okay. Now, when she's in her 40s and 50s, and maybe things didn't work out so well for her employment rise, I'll start tempering that stock allocation. But at her age, yeah, go ahead and be an optimist. Just remember, stocks are not like a certificate of deposit that pays a higher rate. That's probably one of the most pernicious outcomes of Siegel's books. And he's not responsible for what readers do with his
Right.
books.
Exactly.
But all too many readers looked at his chart and said, hey, just like a certificate of deposit, but pays way more. Just hold on. Okay. Unfortunately, stocks are a risk asset. They can perform poorly for a long, long time. So, what I would urge on your audience, Josh, when you invest in stocks, you make a wager. Now, historically, the odds have been good, especially for citizens of fortunate nations, but it is a bet. There is no guarantee. Okay. Now, I've been presenting this material long enough, and had it reviewed often enough that there are three
Right.
misconceptions that I want to rebut or combat here. I do not want your audience taking away either of these three inferences. Okay. So the first misconception.
I
Yeah,
just laugh
McQuarrie.
at because every time you say anything like, "Look, stocks aren't guaranteed." Oh, so you want me all in bonds? Like, no, I didn't say that. I'm just saying stocks aren't guaranteed. That's all I'm saying. You know what I'm saying?
Okay, good. Okay, I'm going to help you out here a little, Josh. All right. So, misconception number one. McQuarrie doesn't think stocks are a good investment for the long run. No, no, no. They have often been a good investment for the long run. It is a wager on favorable odds. And back up a little bit. If you were, if you took a couple of economics classes in college, or heaven forbid, you have an MBA, a major in finance, then you know the theoretical argument for stocks over bonds. Stocks are risky. A government bond is not. You're going to get paid back on a government bond. You may or may not make any money on stocks. And the theoretical argument is investors demand to be compensated for taking on the risk of stocks. And at this point, it's been drummed into a million students over the past 20 or 30 years. Oh, yeah, I get it. Yeah, stocks are risky. So, they have a higher expected return because nobody would take the risk if they didn't think they were going to be rewarded. Well, stocks are guaranteed to win over 20 years. Where's the risk? And if there's
Exactly.
no risk, where's the reward? Okay. So, in a sense, the new historical record resolves a conundrum that had grown up around the Ibbotson-Siegel data. Because again, if there's no risk of loss, there shouldn't be any excess return.
Exactly.
And so all the new record does is it restores the risk of loss. Okay. Doesn't say stocks are a bad bet. It says they're a good bet, but they are a bet. Okay. Number two, McQuarrie thinks I should own more bonds. No, I want to spin that in a slightly more nuanced way. Okay. Um, Under the Ibbotson-Siegel historical record, if you had heart, if you had a spine, if you had a cast iron stomach, there was no good reason for you to own any bonds at all. Okay. Because in the Ibbotson-Siegel data, stocks always win. Okay. And the longer you hold them, the bigger the gap in wealth. The only people that had to own bonds in the Siegel record were the wimps. Okay. The nervous Nellies. Okay. Now, Josh, you're a practicing financial advisor. You know that unfortunately, because investors, most of them anyway, are humans, wimp is a little bit harsh. Okay. I believe the technical term is loss averse.
Right. Exactly.
Okay. And so, many investors are loss averse. I've got an acquaintance, stock market goes down one day and, she's on her phone to you, Josh. Okay. Because I don't like it when it goes down. Okay. So those were the only people who could justify owning bonds under the Siegel record. Okay. Anyone else who was rational and had, kind of a spine was 100% stocks because that maximized their probabilistic wealth outcomes. Okay. So what the new record changes is now even a courageous investor can justify something like a 60-40 portfolio. Here's the reasoning. Okay. What I've shown is that stocks will not necessarily outperform bonds over your particular planning horizon. If stocks won't necessarily outperform, but typically will be uncorrelated or lowly correlated, then with a 60-40 portfolio, you may not be giving up any long-term return, but you will see your short-term volatility shrink. And even courageous investors don't like to see their portfolio bounce up and down. Okay. So it's not that I think you should own more bonds. It's just I think you should consider the merits of a balanced portfolio if you agree that stocks will not necessarily outperform bonds. Okay. Now, number three, this one was a surprise to me. I never dreamed that someone would look at those two international tables 3 slides back or whatever and think, McQuarrie doesn't want me to own anything international. I'm a US investor. Stay away from that garbage. Okay. That's not what I'm saying at all. Here's a metaphor, if you will. So you walk down the Fifth Avenue of Manhattan. You got a little surveyor's laser instrument, by your side, and you measure the height of the first 100 people that you see.
Yeah.
Okay. Well, you probably infer from that sample of 100 that, many, if not most, adult human beings have a height between 5 feet and 6 feet. Okay. But, you'd probably think, 6'6", that's way out there on the curve. Just like 4'10", that's tail risk. Okay. Well, in a sense, with the new international record, 20 countries across 2 centuries, I've taken the Ibbotson sample of 100 years of stock returns and expanded it to 4,000 stock returns. So if you repeated the experiment on the main street of Stockholm, Sweden, do you think your estimate of 6'6" people would go up?
Yep.
And if you repeated it outside the largest high school in Los Angeles, when girls' basketball and volleyball practice lets out,
Yeah.
you think your sense of average female height would change? Of course.
Exactly.
So it's not that you shouldn't own international stocks. I can show you other starting points 20, 30 years where international stocks outperformed US stocks. Okay. All the international record shows is the result of increasing the sample size from 100 years to 4,000 market years. Okay. Now, last slide, and then, Josh, I bet you will have some questions for me. Okay. So, in conclusion, the truth about market history is not so reassuring as a naive reading of Siegel might suggest. It is true. Post-1926 US history has seen superb stock returns. But a more complete history that goes back in time, looks outside the US, gives a darker, shadier, more nuanced view. Bottom line, stocks remain risk assets on any time scale. Josh, the microphone goes back to you at this point. In fact,
Right,
you can pull the slides off if you want, unless you think going to have me go back.
I
here.
do. I want you to go back to the that 20-year time frame from 1946 to 1968, Edward, if you will, because I find this to be remarkable. I want to actually just share with you this from Siegel's own book, because right here you had written an article, a paper that says if we include this time frame in here, stocks will always beat bonds as long as that 20-year time frame is included in there. And I find it very interesting because in Siegel's own book on page 177, this is the 4th edition, Between 1975 and 1983, small cap stocks exploded. During these years, small caps averaged 35.5%, whereas more than double large cap stocks. Cumulative return to small cap stocks during these 9 years exceeded 1,400%. So what he says here, if you took out, shows that the 9 year period, if you took out that 9 year period, the total accumulation in large stocks over the entire 1926, in this case through 2006, is virtually the same. Siegel says that in his own book about small caps, because everyone thinks there's like a small cap bias. But if you take out that 9 year time frame, that small cap bias is gone. The exact same thing happens here. And I'd like for you to talk about that how significant that 20-year period for bonds versus stocks was. And if you remove that, this whole chart is completely different. You see what I'm saying?
Mm-hmm. Okay, let me see what if I can pick up on that. First, I had made that point about small stocks to Siegel and the panel and didn't realize it. Now you've just given me a quote and more ammunition there, Josh, because what Siegel said about small stocks is true. It's someone I read once called small stock outperformance bursty. It comes in bursts, and then they poke along for years and years afterwards. And in fact, you can divide the 1926 to 2023 large and small cap record into basically 6 eras, one of which explains the total 96-year outperformance of small stocks there. But that's a topic for another day. I haven't finished that paper yet. Okay. Coming back to the overall market here. The nature of annualized means, taking the geometric root of something, is that once you've got a fan like that, okay, let's see if I can get it better on the video. Once you've got a fan like that, the only way the stock advantage can go away here is you've got to get equivalent outperformance on, in this case, the bond line. It has to go up at, I think this is about 35x, if I remember, the wealth, okay? And bonds don't do that, okay? Bonds do perfectly well much of the time, but, they don't ever soar the way stocks can soar. Okay, let's see if I can find it in here. 1949 is generally the end of the 1929 bear market and the beginning of the great post-war bull market. In 1954, the S&P index went up 52.6% in 1 year. Okay. In 1958, it went up 40-some%. Okay. And so, this was one of the great bull markets in all of stock market history. At the same time, we're going to go off on a little bit of a tangent here. By the end of World War II, the yield on the long government bond was less than 2%. Okay, less than 2%. Shades of 2020. Okay, and so bonds had after the crash of 1929 and the Depression, bonds had really gone up in value, and there was no place further to go. Now, why did bonds yields drop to 2% in World War II? That's not what happened in the Civil War. That's not what happened in World War I. Well, you know what was different about World War II? Fiat currency.
Right. Federal Reserve.
No more gold standard. And every other war, and this is true even for Great Britain in the Napoleonic Wars, they went off the gold standard too, because wars are very expensive.
Yeah,
We're just
interesting.
gonna forget about that gold standard thing for a little bit, okay? There's going to be inflation. You're going to have to pay 4, 5, 6% to fight a war. Not once you have a fiat currency and an appropriate legal structure, as the U.S. Treasury had. The modern yield curve begins at this point. The
Interesting.
Treasury and the Federal Reserve set the price, the yield on a 30-year bond will be 2.5%. You only got a 20-year bond, it'll be 2.25%. You're down there at Treasury bills, you're going to pay 3/8 of 1%. They set the modern sloping yield curve, and they enforced it to 1951.
No
Okay,
kidding.
so World War II saw the same inflation as World War I and the Civil War. Okay, but bond yields were cranked down and down because the Treasury could do it. Okay, in a way that was impossible
Interesting.
under the gold
Yes.
standard. Okay,
Right.
so now we got yields cranked way below, if you will, the equilibrium
Right.
level.
Right.
These are real values here on these charts. So, the bond investor after the war, inflation, kind of, in the 40s was kind of pretty mean, they turned $10,000 into about $5,000 over these 20 years. Okay. The stock investor turns $10,000 into
Right.
$170,000. Okay.
Ah,
So,
yeah.
and once, it's never going to go away. The particular exercise you mentioned a couple of minutes ago, what I said to myself is, okay, I got a spreadsheet here. I'll make the one line go up like this and the other line just flat like this. And then I'll have them perform exactly the same for the next 100,
Yeah.
200, 500. And finally, after 1,000 years,
Yeah.
the
Right.
lines were back together again. Okay. It's locked in. And
Right.
so I haven't touched on this in the presentation so far, but the theoretical import of the new record is that, asset returns go through regimes, and regimes hold for as long as they hold, and then they go away and they change. Okay. For 150 years, the regime was, stocks will pay you a dividend,
Yeah.
bonds will pay you a coupon. If you can stomach the greater volatility of stocks, sometimes you'll do better. Most
Yeah.
of the time, you'll do the same. And then the regime changed.
Yeah, that's I mean that's very interesting about the bond. That's man, that's interesting because I did not know that, and yet you would think that with the inflation, the bond rates would be sky high, just a la the other times. So I got another question for you, Edward. So the Schiller data, there's a guy over at New York University. I can't pronounce his last name or his name, but he's
Oh,
up there.
Damadoran, I believe it is.
Uh,
He keeps a database post 1927. Yeah,
yeah.
of all kinds of assets, not just stocks and bonds.
So the
A-
question I
a-
have
a-
though is, yeah, go ahead, go ahead.
okay, Aswath Damadoran, if I'm pronouncing his
Yeah, that's
name
it. That's
correctly.
that's the guy's name, right? His data is different than what you had in your article. You're not. I hate to say it's article. It's actually a paper. It's like could be a book, but his data is different than yours, which is different than even Schiller's on the bond side. I'm just like, how are these guys? Like, how is it? And you don't. I don't know if you, I mean. I just. How is it so off? Like some years it's close and some years it's off. I'm just like, I don't get it, man. Like, where are they getting their data from? Or I get where you're getting your data from, but some of that stuff is just not even close. And I'm like, where is this? And then what you said was Schiller using 10-year bonds as opposed to other. I just wondered how. I don't want to sound like I'm disparaging anyone. I'm not. I'm just like this data just seems on the bond side all over the place, and I don't get it. And
Well,
part of your paper you said about municipal bonds, they're using municipal bonds instead of taxable bonds and stuff, and I get that. But anyway, any thoughts on that? How the data is
but
so
you see, Josh, I'm a professor, so I
yeah,
can make fun of other professors. Okay, I can do what you can't do. Now, of course, these are my esteemed colleagues, so I'm not
right,
actually going to make fun of them,
right,
but my voice will drip with sarcasm. Okay, kind of thing. And so here's the deal. Okay, I'm actually not trained in economics or finance. I'm the triumph of the liberal arts education, if you will. Uh, uh, Financial economists are people who have been trained
Right.
in math that is so far beyond my ken, I'm embarrassed to admit it. Okay.
Mm.
So if you have a PhD in financial economics and you are now a professor of finance or economics, you find bond yields to be a fascinating mathematical creature. I mean, you got exponents, you got the natural log. They practically swoon. Okay, yields are fascinating. Okay, bond prices, a change in bond price over some arbitrary period of time, boring old history. Okay, and so honestly,
Yeah.
until I came along, there weren't any histories of bond prices. The people that cared about the 19th century only cared about yields.
Yeah.
It was movements in the cost of money. Let's see. This is Frederick Macaulay's 1938 magnum opus here. Okay. He came up with a yield series back to 1857. This is Sidney Homer's book, A History of Interest Rates, 1963, Siegel source for the pre-Civil War interest rates. Okay, yeah, he was the dean of bond analyst on Wall Street from World War II and really until he died in the late 70s. Of course, he cared about yields.
Mm.
Okay, because he was going to take the yield history back to Babylonian times and did. Okay, and, Macaulay has taken the yield history back to 1857, but what they report is yields.
Right.
Now, I haven't delved deeply into the Damodaran data, but I know he has junk bond returns there, or low grade bond returns, and the way you compute those returns is you go into the Federal Reserve Bulletin,
Yeah.
where from January 1919, they give the Moody's yield average on BBB rated bonds, okay, the bottom of the investment grade.
Right. Right.
Fun factoid. In the 1920s, the bottom of the investment space was the B bond, the BB
Really?
bond. Yeah, the BB bond, not the BBB.
Right.
Okay. More on that in a minute if you care. Okay. So what a Damodaran or any kind of card carrying financial economist does is they say, okay, the Moody's BBB yield was 5.2% here.
Right.
It was 5.05% here. So the bond price must have gone up, and
Right.
I can calculate exactly how much that bond price went up. Okay. And there's my total return series. I just add the coupon to the inferred price appreciation there. Oh, did Moody's remove a bond because it got downgraded during that month? Well, probably. Am
Right.
I taking account of that effect? No, no, no. I'm not bothered with all this bond price stuff. I do yields.
Right.
Me
Right.
do yields. Okay. And so that's how you get those, how shall I say,
Right.
puzzlingly discrepant from reality bond returns.
Well, the minute you said that Siegel worked under Samuelson, I mean, I studied economics in college. I didn't get a PhD or anything, but remember Paul Samuelson in 1989 said the Soviet Union was going to overtake the United States. That was his projection. Him
You've
literally
never
writing.
forgiven him for that.
I just, it's, even, I find the whole thing, these econometrics and stuff that Samuelson came up with is whatever. I have a hard time.
Josh, you're not getting it. You would, if you were a math major, you would be much more appreciative. This
Uh, the
this
uh,
is beautiful mathematics.
Yeah, the physics envy of the economics field is mind-boggling, and then the math envy of the physics field. So you start with the math, and the physics had envy of the mathematicians, and the economics had envy of the physicians, the physicists. It's crazy.
Yeah.
That's that's just Edward. The history is just fascinating to me. That's why I like your stuff is the history. I get bored of just people. I just frankly the financial stuff just bores me. I'm just like whatever because no one knows. But I like the history behind it. It's like a history lesson of your stuff that is more than and Siegel to his credit. I mean, there's a lot of good stuff there, a lot of good tidbits in there. But I like
Yeah.
the history of how this comes to be. Yeah, right.
See, I get all 6 of his books there. I had to lay them in for professional reasons, and yeah, there's a lot there. It's become almost a general general book on investment theory and management, and the history for Siegel is only a small part of it. I
Yeah,
think one of the reasons I was able to make a contribution
right.
is, for me, the history is the whole part of it.
You ever heard of Mandelbrot, Benoit Mandelbrot? You ever read him stuff? His
Oh, you mean
yeah,
this one? I
what's
think
it? I can't see what it says. Yes, that one
misbehavior of
right
market.
there. Yes, yeah,
Yeah.
that was fascinating too. I thought that was
Okay.
very very interesting. Yes.
Okay. So he's in the discussion section of the Financial Analyst Journal paper because Mandelbrot is already always about fractal patterns.
Yeah.
Okay, that the pattern at this scale pattern is scale independent. Okay,
Yes.
and certainly one of the ways to interpret the new history is everybody knows stocks can be volatile over 1 year, but we had very, very few 10-year samples. Okay. And so on a Mandelbrot theory, patterns should be scale invariant. And so we should have those international results where stocks go way down over 20 years, same as over 10 years or 5 years or 1 year or 1 month. And yeah, so I'm right with you on Mandelbrot and Hudson there.
I'm saying it. I thought Mandelbrot. I didn't know it was called Mandelbrot. Interesting. I
Oh,
just
never trust me on pronunciation. My mother's mother was French Canadian, and if you talk to me long enough, and I grew up in Eastern Massachusetts, you may have already figured that out. If you talk to me long enough, I will mispronounce something. I
actually
guarantee
I
it.
thought you're from the South because I'm from Maine originally. You said kept saying length, and I thought that was a Southern thing. Length. It's funny. I didn't realize you're from Eastern Massachusetts. Yeah, right on.
Oh yeah, no. Hey, and Josh, I was looking at my watch here and thinking, for your viewers' sake, we should probably wrap things up a little bit. Final question for me?
Nah, I'm good, Edward. This has been fantastic. I'm much obliged, and we'll put the links on your stuff in here, and for people to download and read. And I got a lot of engineers on my YouTube channel who I get a lot out of this stuff. A lot of retired engineers with time on their hands too, if you know what I'm saying. So I think they'll get a lot out of it. And you don't have a YouTube channel or anything. You just write for the you just write and write on for
Actually, what I'm starting to branch out. Okay, I was I'm going to repurpose an old Jesuit joke. Santa Clara is a Jesuit university. The old joke ran something like this: give me the young man for 7 years on the tenure track, and he'll never stray from the true faith. He'll know that a peer-reviewed journal article is the highest and greatest form of human knowledge. Okay, I'm getting over that slowly, but it's been a long journey. And so some of you viewers will be familiar with bogleheads.org.
yes, absolutely.
I've become posting pretty regularly there under the username MCQ, and that's one way to hey, ask me more questions after the presentation is
Right
all
on.
done. All
On
right.
Bogleheads, MCQ on Bogleheads. Right on, Ed. Good stuff, man. I really appreciate it. I'll let you get back to all those books. I'm sure your wife is happy when you see all these Amazon boxes show up. They say the anti-library. That's what Nassim Taleb calls it. The anti-library. Every time you read a book, you add five more to your stuff there. And
Yeah, yeah. Hey, you see those bookshelves behind me? Take care, Josh.
God bless.
It's been
Thanks,
good.
Ed.
All
Appreciate
right.
it.
Bye bye.
Bye bye.